Here's the truth nobody likes to say out loud. Inflation is not an accident. It's not a mystery, and it's definitely not caused by you buying groceries or ordering takeout. Because if inflation were really about too much spending, then prices would fall the moment people ran out of money. They didn't. Instead, prices stayed high, even when savings dried up, even when credit cards maxed out, even when demand supposedly collapsed. So the real question isn't why prices went up. The real question is, who actually has the power to keep them there, and why do they never get mentioned? Pause for a second and think about who you've been told controls inflation. Politicians say it's reckless consumers. Commentators blame stimulus checks. Some even blame workers asking for raises. But let me ask you this. If inflation were really driven by average people, why does it surge most during crises they didn't create? Why does it persist even after demand cools? And why does it always seem to benefit the same small group at the top? That's where this story actually begins, because inflation isn't a force of nature, it's a system, with incentives, with levers, and with winners. And once you see who holds those levers, it becomes very uncomfortable. Let's rewind to how inflation is supposed to work. In theory, it's simple. Too much money chasing too few goods. People spend more, prices rise. Eventually, demand drops, prices stabilize. Nice, clean, almost elegant. But that story assumes something crucial, that prices are passive, that companies simply respond to costs, that no one has pricing power. And that assumption quietly died about 20 years ago. Because today's economy doesn't look like a farmer's market. It looks like a handful of giants controlling entire sectors. 5 companies dominate food. A few banks control credit. Energy, shipping, housing, healthcare, same story. When markets concentrate, something changes. Prices stop being reactions and start making decisions. This is where inflation stops being abstract and starts being mechanical. Let's talk about how prices actually get set. Most people imagine prices rising because costs rise. Oil goes up, wages go up, supply chains break. Sometimes that's true, but here's the part rarely explained. When costs go up by 5%, prices often rise by 10% or 15% or 20%. Not because they have to, but because they can. And once prices rise, they rarely come back down. Why would they? If consumers absorb the increase, if competitors match it, if profits expand, lowering prices becomes optional. That's not inflation caused by demand. That's inflation locked in by market power. Let's ground this with a simple example. Imagine 3 grocery chains controlling most of the food in your city. Their costs rise slightly. They raise prices. Customers complain but keep buying. Sales volumes dip a bit, but profits rise. Now ask yourself, what incentive do they have to reverse those prices later? None. And here's the twist. They don't need to coordinate. They just watch each other. One raises prices, the others follow. Margins expand across the board. This is called price leadership. It's perfectly legal, and it's everywhere. This is why inflation feels sticky, because it's not being driven by chaos, it's being maintained by structure. Now let's talk about the institution everyone points to as the hero, central banks. You've been told they fight inflation by raising interest rates. The story goes like this. Higher rates make borrowing expensive, spending slows, demand falls, prices come down. But notice something. Interest rates don't touch corporate pricing power. They don't force companies to lower margins. They don't break monopolies. They don't increase supply. What they do affect are workers. Higher rates cool hiring, slow wage growth, increase layoffs, crush small businesses. In other words, central banks fight inflation by weakening labor, not by confronting price setters. And this creates a quiet contradiction. If inflation were really caused by workers demanding too much, then suppressing wages should fix it. But prices stayed high even as wage growth slowed. Why? Because the source wasn't wages, it was the margins. During the recent inflation surge, many large corporations posted record profits, not despite inflation, because of it. Earnings calls didn't sound panicked, they sounded confident. Executives openly talked about pricing strength, margin expansion, passing costs to consumers. That's not a system overheating by accident, that's a system exercising control. Now here's where the math gets uncomfortable. Inflation isn't just higher prices, it's a transfer. From savers to borrowers, from workers to asset holders, from people paid in wages to people paid in ownership. Inflation quietly erodes cash, but assets inflate right along with prices. Stocks, real estate, businesses. So who benefits? Those who own things. And who loses? Those who live paycheck to paycheck. This is why inflation feels so personal. It hits groceries first, rent second, utilities third, the things you can't avoid. And while you're adjusting your budget, the system quietly adjusts upward. Now contrast this with the public narrative. You're told inflation is your fault. You spent too much. You demanded too much. You lived beyond your means. But the data tells a different story. Household savings fell. Consumption slowed, debt increased, but prices stayed high. Why? Because inflation wasn't being driven by excess demand anymore. It was being maintained by concentrated power. And here's the irony. The same system that claims inflation is dangerous depends on a low, steady level of it to function. Debt becomes easier to manage, asset prices rise, governments inflate away obligations. Too little inflation causes panic, too much causes unrest. So the goal isn't zero inflation, it's controlled inflation, predictable, manageable, uneven. Now ask yourself something. If inflation were truly the enemy, why do the same policies repeat every time? Raise rates, protect capital, absorb losses at the bottom. Because inflation isn't just a problem, it's a tool. Used carefully, defended publicly, denied rhetorically. This doesn't mean there's a secret room where people decide prices. It's more subtle than that. It's incentives aligning, market concentration, pricing power, financial structures. Once you see it, you can't unsee it. Inflation isn't controlled by shoppers or waiters or people asking for raises. It's controlled by who has the power to set prices and who doesn't. And that raises one final uncomfortable question. If inflation isn't really about demand, if it isn't caused by workers, if it benefits asset holders more than anyone else, then what would fighting inflation actually require? Breaking concentration? Reducing pricing power? Rewriting incentives? Or are we going to keep pretending it's about lattes and groceries while the system quietly keeps doing exactly what it was designed to do?